and welcome back to whiz. In this video, we will discuss a fundamental trading principle which is of utmost importance for amateurs and professionals alike. It's a principle that helps investors understand the relationship between the potential gains and losses associated with different investments. In the vast ocean of finance, risk and return are the waves and currents that propel us forward or pull us back. Understanding their intricate dance is essential for any investor who wants to navigate this dynamic landscape and reach their financial goals. A quick reminder, please do subscribe to our channel whiz if you haven't done so already. And if you like the video, do give it a thumbs up. Your show of support really motivates us to keep creating more content for you all. At its heart, the theory of risk and return revolves around a fundamental trade-off. Higher potential returns are generally accompanied by higher risk. The more volatility an investment carries, the greater the chance of significant gains or losses. Conversely, safer investments offer lower returns but also provide relative stability. Imagine investing in the financial market as navigating a vast ocean. Just like the open waters present both exciting opportunities and lurking dangers, your investments are exposed to different types of risks. Two key players in this game are systemic risk and unsystemic risk, each posing unique challenges and demanding distinct strategies. Think of systemic risk as a massive storm engulfing the entire ocean. It's a risk that affects the entire market or a large segment of it, like a financial crisis, recession, or a natural disaster. No matter how skillfully you sail your individual ship or investment, you can't escape the waves and winds of this widespread phenomenon. Some examples of systemic risk are economic downturns, when the overall economy takes a nosedive, unemployment rises, businesses struggle, and even the most solid investments can experience losses. Interest rate fluctuations. Sudden changes in interest rates can impact the value of bonds, stocks, and other assets, throwing off financial calculations and potentially leading to losses. Geopolitical events. Wars, political instability, and other significant global events can trigger market panic and widespread losses. Since systemic risk affects the entire market, completely avoiding it is nearly impossible. However, you can employ strategies to minimize its impact on your portfolio. Number one is diversification. Spreading your investments across different asset classes like stocks, bonds, real estate, and industries can help cushion the blow if one sector is hit hard. Number two, investing for the long term. Systemic risks are often temporary, so staying invested during market downturns can allow you to ride out the storm and benefit from eventual recovery. Next, maintaining a financial buffer. Having an emergency fund can help you weather financial difficulties caused by systemic events. Unlike the all-encompassing storm of systemic risk, unsystemic risk is like a leak in your individual ship. It affects the specific companies, industries, or even individual investments, leaving others relatively unscathed. Think of it as a rogue wave that might capsize your boat while all others sail smoothly by. Examples of unsystemic risk are company-specific issues, a company facing financial difficulties, leadership scandals, or product failures can experience significant losses, impacting its stock price and potentially harming investors. Industry-specific challenges, technological disruptions, regulatory changes, or shift in consumer preferences can negatively impact specific industries, causing losses for companies within that sector. Management decisions. Poor strategic decisions or mismanagement by a company's leadership can lead to financial losses and decreased investor confidence. The good news is that unsystemic risk can be mitigated through strategic portfolio management. Number 1, diversification. Again, spreading your investments across different companies and industries reduces the impact of any single event on your overall portfolio. Number 2 is research and analysis. Thoroughly researching companies before investing can help you identify potential risks and avoid those with red flags. Next is asset allocation. Adjusting the mix of stocks, bonds, and other assets in your portfolio based on your risk tolerance and investment goals can help manage an unsystemic risk. By navigating the intricate dance of systemic and unsystemic risk, you can become a more informed and resilient investor. Remember, there's no one-size-fits-all approach, and the ideal strategy depends on your individual goals, risk tolerance, and time horizon. With careful planning, diversification, and ongoing research, you can chart a course through the financial ocean, weathering the storms and reaching your desired destination. Now, the financial world presents a kaleidoscope of assets, each with its unique risk profile. First is equities. Stocks, the engines of wealth creation, offer high potential returns, but also expose investors to market fluctuations, economic downturns, and company-specific uncertainties. Small cap stocks, though offering faster growth, hold higher risks than stable blue chip giants. Debt instruments, like bonds, issued by governments or companies provide fixed income at regular intervals. While less volatile than equities, they carry interest rate risk. Bond prices fall as interest rates rise, and credit risk. The issuer might default. Government bonds are considered relatively safe, while corporate bonds carry varying degrees of risk depending on the issuer's financial health. Real estate. Investing in land or property can offer long-term capital appreciation and rental income, but comes with high entry costs, illiquidity, and risks associated with construction delays or legal issues. Mutual funds. These professionally managed baskets of diversified assets offer investors a convenient way to participate in various asset classes, mitigating risks through diversification. However, fund performance depends on market conditions and the skill of the fund manager. To navigate the risk-reward spectrum effectively, investors rely on tools that quantify risk and potential returns. Number one is standard deviation, a measure of an asset's volatility indicating the potential for fluctuations around its average return. Number two, Sharpe ratio, compares average return to volatility, rewarding investments that deliver higher returns relative to their inherent risk. Number three, Beta, measures how closely an asset's returns move with the market, aiding in portfolio diversification to smooth out overall risk. The theory of risk and return goes beyond mere statistics. Several factors influence the dance between risk and reward. Economic conditions, inflation, interest rates, and economic growth can significantly impact investor sentiment and asset prices. Geopolitical events, international conflicts or political instability can trigger market turbulence and affect returns. Regulatory environment, government policies, tax laws, and central bank action play a crucial role in shaping risk-reward dynamics. Understanding your own risk tolerance is critical for formulating an investment strategy. Conservative investors prioritize security and focus on debt instruments and low-risk equity funds. Moderate investors seek a balance between risk and reward, diversifying portfolios across equities, debts, and other asset classes. Aggressive investors, comfortable with higher risks for potentially higher returns, focusing on growth-oriented equities and small-cap stocks. Navigating risk and return requires constant vigilance. Diversify your portfolio. Spread investments across different asset classes to mitigate risk and smooth out returns. Invest with a long-term horizon and stay focused on your financial goals and avoid short-term market fluctuations. Conduct thorough research. Analyze investments carefully and seek professional advice when needed. Remain adaptable. Be prepared to adjust your strategy as market conditions and your risk tolerance evolve. The principle of risk and return is the compass that guides investors through the dynamic waters of finance. By understanding its intricacies and tailoring your approach to your risk tolerance, you can chart a course towards achieving your financial aspirations and weather the inevitable storms that come with navigating the ever-changing landscape of the financial world. So that was the risk-reward principle. In the words of Nelson Mandela, without risk, there is no reward. By reflecting on these words and understanding the inherent relationship between risk and reward, we can make more informed decisions in our lives and pursue our goals with greater confidence and clarity. Remember, the key is to find the right balance between risk and reward, one that aligns with your own individual circumstances and risk tolerance. By taking calculated risks and making informed decisions, you can increase your chances of achieving success. Thank you for watching. If you liked the video, do give it a thumbs up. and share it with your family and friends. I would love to know your views and questions on the topic, so please do leave a comment. And do subscribe to With Sikhya for more knowledge from the world of finance. See you in the next video. Till then, happy learning.